how does the current crisis compare to previous ones, most notably the financial crisis of 2008, 2009? Things fallen more or less, more quickly, more solid?
Well,
How does it feel?
I think they haven't fallen as much if you look at 2008, 2009, and similar to other crises, probably not fallen as much yet. But the difference on this one is the speed of the fall. So it was all done in, sort of the space of 3 to 4 weeks. We got the fastest ever bear market in the States, so the fastest fall of 20% that sort of had happened. But the depth isn't the same yet. I say yet because we had a sharp bounce back. So we don't quite know what's ahead of us at the moment. We still don't quite understand that. So that's the market fall. Economically, we don't know the damage, as I said, until it's played out a bit more.
Okay. So the other question that I have been asked, and I've kind of got my way through it, but it's when are things likely to improve? Possible question, perhaps. And how will we know when we're through the worst of it?
Well, on the, I'm afraid the Waverton, crystal ball has been furloughed. But I'll have a crack at that one anyway. But I mean, I think, again, it's two questions. It's economics and it's markets. And I think the market improvement that we've seen has been, a big sharp bounce back. And we think that's overdone. And the reason we think it's overdone relates to the other point, when the thing's going to improve economically. And we think they're going to take a lot longer to improve than the market seems to be giving credit for at the moment.
Right.
I think when lockdowns end, even if it's bit by bit, the world will be a different place. And it's very hard to understand quite how that will be and what's happened to human nature. At the same time, I heard someone comment on the radio this morning is, if you're allowed to go to a restaurant, what's it going to feel like when you're being served by someone with gloves on and wearing a mask? It's not the same. And I think it will take a long while to get over that.
Okay. So you're thinking like just the practical impact of people going out for restaurants less, going on holidays less, and what that might affect economically?
Exactly. Just because the lockdown ends, I don't know about you, but I'm certainly not going to be happy getting straight back on tube trains. I don't think people are going to be happy jumping on aeroplanes straight away. I think the world definitely changes. Even big things, global supply chains are going to shorten because you can't run the risk of not being able to get your goods from China anymore. That will shorten things. The world comes a little bit more Trumpian, looking after yourself, as it were.
Yeah. Okay. One of the phrases that my clients will repeatedly hear from me is that there is a distinct difference between a fluctuation in the value of an investment or a temporary decline, potentially. There's a distinct difference between that and permanent loss of capital. The two things are very, very different. We accept that the value fluctuates, but that ought to not lead to permanent loss of capital if we've invested appropriately. So how does Waverton manage or protect against a temporary decline turning into a permanent loss of capital for a client?
Yeah, no, that's a good question. And that's really, that's kind of what we're paid for, right? That's the active management. So you've selected for your clients, or your clients are selected with you, the appropriate mandate, the appropriate risk tolerance, that deals with, what they can cope with in terms of the ups and downs and still sleep at night.
Absolutely.
And then it's incumbent on us to manage within each of those mandates to make sure we stay within appropriate risk parameters. So as a good example of that, in the last 12 to 18 months, not that we didn't see the crisis coming, but we saw equities getting more expensive and we saw economies being more challenged for growth. So that is a natural indicator to us to start reducing risk within portfolios. So we made 2 cuts to our equity weights last year, made a significant reduction to the corporate bond exposure that we have in client portfolios, and we upped some of the hedges and some of the protections that we have, so that when we entered the crisis, the portfolios were far more robust than they might otherwise have been. And we had, on a relative basis, we didn't have such a bad time.
Yeah. Does that, reducing equities over that period of time, is there a way that could impact long-term performance because you're trimming equities?
Well, yes, if you trim them and leave them and that's it. But like I say, you have to manage actively. So we added back to equities on the 17th of March, which was a tough call, right? Because that was a bad time. Everything's going down, but you still have to try to understand the values and what's going on. our fixed income exposure had protected and performed particularly well. So we switched some of that into the equities to give us some dry powder to make the most of some opportunities. Similarly, we did it with real assets. So things like some property and infrastructure funds, we bought those pretty close to the bottom as well to allow you that participation, because you're quite right. The long-term objective is to achieve inflation plus. A core part of that is obviously protecting on the downside, but you have to make some money. You have to participate to some degree on the upside as well. So, mindful of that when things are bad, you have to start dipping the toe back in as well. So that's all part of the through the cycle active management that you suggest, and that does help you avoid the permanent capital loss as well. With the protections. I mean, just quickly, I mean, the ultimate protection that the client has is the work they do with you, that they can decide then what their time horizon is, and if they're in an appropriate time horizon after the work they've done with you, they can afford to look through the peaks and troughs that tend to with their chosen mandate anyway.
Yeah, that's the issue that we often talk about with my clients, is that it's the sort of logic versus feelings in a way, because logically we can put a portfolio that we know is going to do the job over the next 5 to 10 years. But when we have those moments where it falls 10, 15, 20%, whatever the portfolio might fall in, it just doesn't feel nice.
No, it doesn't.
So that's that bit
to do. At times like that, you've got to sell the things that have performed really well. So your protection, your hedges have gone up. And you've got to, it's no good having them if you don't take profit out of them, because they can reverse very quickly. So it feels like the hardest thing to do. You're selling the only thing in your portfolio that's done really well, and you're adding some of that cash to parts of the portfolio that really haven't. But that's what they're there for. That's you have to be quite cold-headed about it.
And is that where the team approach at Waverton, where there's obviously not just one person doing everything, you've got that dialogue within each other, you can navigate?
Absolutely. So, and it, it's been more tested than we can ever have imagined this time around as well. So obviously you've got an ongoing dialogue, way beyond normal office hours anyway. But also way beyond the office space. So we're all doing it on Teams, on Zoom, conference calls, whatever it is. So it was working. You've got to say it's exciting, right? These are the periods as well that you look back on in your career and you remember. So the younger guys, the first time they've been through this sort of thing, there's 3, 4, 5 of us on the team. I'm afraid we've been through more than we can remember. So you get a bit battle hardened to it.
Very good. And it's another question that I've had a couple of times is, what opportunities do you see amongst all the doom and gloom, and is there anything that you're able to take advantage of, and if so, what is it? We did
opportunistically. We were in, really they were sort of the opportunities that were thrown up by the market volatility. So I mean, I suppose a good example is we own a company called BB Healthcare. It's an investment trust that invests in healthcare companies, obviously, but on the technology side of things, so high-tech healthcare companies, and it trades at a very level value to its net asset value. Quite often these can trade at a big premium or big discount, but it tends to trade very steadily. There was a moment in time in the crisis where there was a forced seller which put the holding on a 14% discount to its true underlying value. And because the structure of our portfolios allow us, we're known to the managers, so we get a call, say, look, do you want to pick some of this stock up? And so we're able to pick up at those levels. And so long as we've done the work on the company and we feel that it's not representative of some underlying issues, it's things like that you can make the most of in these crises. And it's those little incremental things that you do that add to the longer term gains that you can get for to lock in. But I think in general, when we come out, it's too soon to make decisions. There will be some areas that are extremely challenged. I think obviously airline, travel. I think central London office space, for example, is a great example of this crisis has speeded up the process to working from home and things like that. So, are we going to need the amount of office space at Waverton? No chance. We're probably looking at half the space going forward.
Wow.
And if you multiply that across the financial services sector, what happens to places like Canary Wharf and, that's going to have office space empty. So there are a number of areas that need serious consideration in terms of possibly avoiding, but then possibly some of the tech companies, the Amazons of this world, are going to do a lot better than we imagine. Netflix and the like.
Do you ever think of the ripple effect of people perhaps commuting less, so revenue on trains, cups of coffee, sandwiches, that things people buy just because they're out?
Well, I've been trying to think about a lot of those things. What is the impact? So obviously trains, HS2 and Crossrail and all these great projects that are being done. Maybe we see the sort of the number of commuters falling greatly anyway. I was thinking about local high streets as well.
Yeah.
It could be more beneficial to local high streets because more people working from home. When I'm going down my high street to get my coffee instead of popping across Piccadilly, and small independently owned cafes owned locally and things like that might benefit from these things. But it's good to think about these things, but it's hard to know exactly yet how it all plays.
Yeah. I suppose that's where coming back to just the basics of having a diversified portfolio, things well spread.
Yeah. I got asked that question the other day. What's the most protective thing that you have in the portfolio beyond your hedges? And it's a very boring answer, but the bottom line is it's the portfolio as a whole. It's having all these different moving parts together, as much diversification as you can in terms of risk reducers, but also in terms of the things that you're trying to get some growth from. It's a boring answer, but it's a true one. It's a well-diversified multi-asset portfolio coupled with the appropriate time horizon that you've sorted out with the client. That's what gets you through. That's what achieves your long-term objectives and helps you sleep at night through periods like this.
Fine. So my last question then is there anything that's happening through this crisis that you think may affect the portfolio's ability to still generate or still achieve their long-term objectives?
No, you know what? I'd say exactly the opposite, because the portfolios in their current guise have been running really since probably 2010. And so apart from a few sort of humps along the way, we've seen rising markets and you don't get a proper test. This has been a proper test for the portfolio. So this is what I now refer to as a full cycle. And when we look back at the returns, including the gentle up with the big bang at the end of it, the portfolios have performed really well. They don't shoot the lights out on the way up, but they do protect on the way down. And when we look back over the longer term now, all of the mandates are still ahead of their CPI plus targets over the longer term. Which is all we can hope for.
Well, even after the recent fall?
Even after the recent falls. So for us, that's proof of concept.